Hello everyone, this is Juan Sarmiento and today is Friday, June the 3rd. Let's get quickly started with our current positions and then we'll see if there is a time for us to do some potential trades, okay? If this is quick, it should be. Let's start with Adobe here, analyze, and what do we have? Well, we're right here, June the 10th, that's a week from now. We could enlarge it or increase it. Let's see, we're here today, 7:30. Let me reset the slices. Okay, we're negative here. This is where really we are not up here. Okay, I don't know if I should do anything. Let's see, add simulated trades as June. That's a week from today. We have the calls at 460. The stock is trading at 429. We can roll this call. We have the put at 390. That's way out. There's not much there in value. Let's go to the account position here. And let me just put the one account. We have 103,791. Okay, let's go to the account statement, and here we see, let's organize them alphabetically. Adobe here, you can see that the market value of my position is 3,598, and we have a P&L, a little loss there, 3.95. So what I'm going to do is I'm going to simply do a rollover and analyze rolling. Not much. We could actually close this position. There's not much point in doing that. Let me see what the trade looks like. We have this earnings coming up here on the 16th. Yeah, I think we should close this position at this point because earnings are coming up. So let's analyze that. We're going to close the call side first, which is analyze closing, calendar, custom. We need to short 2. And that's, if we remove the put, then it's a straight line and we are going to take our profits here. Meaning close the position. It's not a profit, it's a slight loss, very tiny loss. And then you can leave the put here. We could leave that put, but that's, yeah, we may as well take the credit on that because it's about $1,000. $1,085 for the put side, and we'll wait. Okay, the put side got filled. Let's wait for the call side. We can adjust the price as we go along. I'm asking for a credit below market price. We'll wait a little and see what happens. Let's go to Costco. Let's look at Costco. I believe it's rallying. Volatility has dropped. Okay, let's go to the Analyze tab. That looks pretty good here. June, July. We could, 600 is way up here. So that's not much use to keep either. So let's, the way I would do this, I would do one at a time. Call side, put side. Okay. Let's start with the call side. Analyze rolling. And that will close my position, but I need to go to July 15th. Get 35 cents out of that. Okay, the Adobe position has filled and we no longer have an Adobe position. Let's close this. And that was the Costco calls. Now we have one long call here. 33 cents on that. You can close this in whatever way you think it can be done easily. Then the 600 put, $0.20, and then the 395 put. You can count that these things will fill fairly quickly because the volatility is high right now. When the volatility is low, these things may take longer to get filled. That's it. We got out of our Costco. Let's go to Nike. Nike also quite bullish. Let's take a look at our position. Is a little too bullish, I think. And yeah, the market bounced. We made additional money. I think it's time to leave that to the calls. Let's close the long calls. And ironically, my put side calendar is adding positive deltas to my position. Let's close this put here, but let's do the calendar first. And we close the put as well. Okay, now we have the calendar, but that's bullish, so we're going to check on that later. Yeah, and then Oracle. What do I think? Oracle looks like it's going up. It's toppy here by the stochastics. It's giving me a weak signal here. The Ichimoku clouds overhead and earnings are coming up. I don't want to stay any longer on this one. And although it looks pretty darn neutral here, but we have June and we would have to change this. I just as soon get out. Let's get out of the call side first. Call calendar. Correct that. We need to sell 12. And the put side, we have 3 and 1. Let's analyze that. Okay, and we have 3 longs that we're going to sell. You just say custom and then change the numbers like that. If we were out of the call side, it would neutralize everything, and there it is. You still have quite a bit of the put side here, 19. Set. Okay. While we wait here, we wait until this gets filled. You need to confirm that the the mark here is bigger than our current asking price, and that's pretty good, so we should get filled. Okay, now let's look at some potential trades since we have now cleared out old trades. Feel free to do that, feel free to modify them, but be careful with earnings, is what I would say. Okay, let's look at UPS is my first candidate. Okay, so I'm going to show you my thinking process. I haven't done anything other than enter the trade here. Let's copy that and put it into my platform here and paste it. Here it is. Okay, let's analyze that. Analyze trade. And this is what I'm doing. Just to review, I'm selling 2, 1 call, 1 put front month options as close as I can get it to the strike price. The current price is 184. The strike price is 180. You could do 185 if you wish. I'm not going to bother with that. I think this is fine. And the long, I'm buying 2 long straddles, meaning 2 calls and 2 puts. Let's look at the add simulated trades so we can see the date of the options that I'm proposing to. This number here in parentheses is how many days to expiration. So the October expiration, that's 140 days. That's more than 90. That's what I'm looking for. Okay, it needs to be more than 90, so 140 is what I'm getting. And that was Oracle. I'm out of the Oracle position. Okay, now as far as the front month option, that's July 1st, that's 28 days. Very close to 30, which is what I would say is correct. Is good. Let's look at the chart of UPS. They reported earnings. They beat expectations. Despite of that, the market went down. Is likely to rally some more, or perhaps not. Look at the volatility is here near the bottom of the year. You can confirm that going to the trade tab, UPS, scroll down, and you see here that it says current IV percentile 34. It's really not that much, but you see, you look at the, yeah, it could be much lower at 20, it's at 30 right now, 31. It's relatively low nonetheless. And you see the green light is because the historical volatility is larger than the implied volatility. So the implied volatility might tend to rise. And if the market will continue to go down, UPS will go down with it. Right now it's correcting a little bit and likely to go to the Ichimoku cloud. We'll see what happens there. It might break out and go test the highs again. It seems unlikely with this market, but things change. Okay, so that's, I like that because it's rallying quite strongly from the bottom here. Okay, from 164, it's gone up to 185. Okay, so that's 20 points, 22 points. Okay, so big move up, good earnings. Now we're gonna go and examine the trade. All right, this is my chart, and this is the trade I'm entering. All right, and how much does it cost? It costs $443.50. Okay, so we may enter. I'm going to buy, sell 1 contract, buy 2. What is the expiration? Well, you can fill that up. I'm not going to bother because I want to go quickly through this. But if you keep track of all your trades, you would enter that, all the prices and all that. The price will be 180. Okay, and the cost, you just enter it here, and it is $43.50. Okay, and how many am I going to have? Well, you multiply that times 100, that's your cost for $43.50. Because I have more than $100,000 value in my account, I can do twice that much, so I multiply times 2, and that's $8,700 for this trade. Earnings, what was expected versus the actual is 305 was the actual, 3.05, and what was the expected? Oops, give me the proper tool here. Okay, what was the expected here? 287, so that's an earnings beat. And when we enter 2.87, I calculate what was the earnings beat? 18 cents or 6.3%. I'm looking for a beat of 10% or more, so that's not good. That's a strike against it. So let's put this the right color for it. An orangey color perhaps. Instead of green, put an orange. Let's do not trade. Okay, volatility. Let's go to the trade itself. analyze, and here's my trade. You can enter those numbers. You have on top is the buy or the back month options, and below is the front month options. Here at the bottom right corner of your screen, that's the volatility VOL for each one of those options, and I'm gonna enter them here in my form. Okay, 33.31, 28.94, okay, versus 31.16, 28.55. It's changing, of course, as we go. It says 1.27. It's narrow. The range between volatility skew back month versus front month, it's narrow. It's less than 3, so it says trade. Liquidity. How do I calculate the liquidity? I say create duplicate order, and here you have the mid versus natural. Those are the two numbers that you're going to enter. Mid is 43.43 versus natural 44.35. Difference of 2.1. It says trade. That's a green light for that. Okay, color fill, green. There. And of course, the current IV percentile is a little higher, but with those two filled, I say, let's go for it. Okay, if you're motivated, it says do not trade, but it's still pretty good 6.3. So I would say it's 2 out of 3, and I'm motivated, so I enter it. Okay, so confirm and send. And now we're going to say multiple so that I can change the number of the quantity here, the number of tranches. Okay, I'm going to do 2, and that adds up to $8,730. Let's send that off, and let's move on. My next entry is the LTR, and that got filled very quickly. Right, anyway, there it is. You can check it by risk profile, remove the existing simulation, and here it is. Okay, that's my trade, and here's the P&L as of entry 0. It's not changing, minus 20. Okay, let's move on to the next trade. You can see it here, UPS. Okay, let's move on to the next one is DLTR. Let's copy that and paste it here. Let's paste it here. See, where is it? Oh, here it is. Paste. Here it is. And now we can analyze trade. Here's my trade. And you can tell that I'm not going to like it because the implied volatility, this is a big no-no. The September option that I'm proposing to buy is 40.57, so forget it. That's not going to be good. And not to mention that the front month options have 35, it's more than 5%. Take a look at the chart. Yeah, it did rally strongly after earnings, but the volatility is still up there for the back month options. So I'm going to say no, we don't want to do that. Okay, so that's a no. I don't go any further. It's just the volatility is high and it's going to make come lower, and then you are going to lose weight. We're going to lose value very quickly, not weight. I'm thinking of my other aspect of life. Anyway, let's move on to the next one, which is Marriott. Let's copy the trade, and then if everything checks, we move on to the evaluation of the trade. Okay, so here it is. I'm just gonna click on order right here. Bang, it shows up, and then right click and say analyze trade. And here it is. Open it, and it's 50.95. Okay, And again, we have a 40% implied volatility on the back month option. So that's not going to work either, even though it may have been a lower volatility early on today. And sad because this is moving very strongly and they beat expectations, but no can do. Okay, this is not going to work for us. So why? Because the volatility may still come down, and at 40% implied volatility, this could go much lower. Look at the volatility here. It has been at 30, so that's a 40% implied volatility. What happens? Well, let's take a look. Assume that we enter this trade and then volatility decline. Volatility, you can test it by saying volatility adjustment right here and say minus 10. And then look, you lose money. Okay? $1,000. So we are not in the business of losing money, are we? Not intentionally anyway. So let's move on to the next. Is Amgen. Let's copy that. I'm copying the trade, pasting it here, and we're going to go through the same process of elimination. Paste there, analyze. And what is the implied volatility on Amgen? Oh, this is way low. But look at this, 17, 24, this might not be good. Okay, September will be how many months from now? How many days? September, yeah, that's 100. And July 8th, that's 35 days. You can do the July 1st, if it's any better. Let's analyze trade and put, instead of July 8th, let's put July 1st. Okay, not much different really. It's about the same volatility. It's a little higher. We can do this one here. Okay, let's move on and take a look at the chart. Where is the implied volatility? Well, looks a little yellow here. It's not green the way I would like it to be, which means that the historical volatility is actually lower than the implied volatility. Okay, so no, we don't want to trade that either. They reported earnings here, and that was a little ahead of expectations, but not by much. So that's not going to be surprising. So again, that's a no, because the volatility is still declining. Okay, let's move on to the next trade, and that's AXP. Let's copy the trade here. And paste it here. Analyze the trade. Let's remove the previous trade there. There it is. Nice. Okay. I see 36, 35, 33, 33, 36. Yeah, this is okay. The call side is higher than the put side. Let's take a look at the chart. Look at the earnings. The earnings came better than expected, but the stock declined anyway, and it's now bouncing back. If any stock is going to break out, this could break out because it has good earnings and decline anyway, so it could break out. The volatility is green, so let's see how it all works out. Let's go to the Analyze tab. And let's analyze it here. The cost 39, I'm going to do that last, the cost and so on. Let's go to the earnings first. Chart, earnings, 2.73 versus 243. 2.43 versus 2.73. Yeah, that's more than 10%. It says trade. Okay, volatility, we go to the Analyze tab, and that should be a no-brainer too. Here is the back month. 35, 33.43. And that says trade. It's very close to equal in both sides. Liquidity, we unlock it first. Create duplicate. 39.13 versus 40.2. Okay, so the mid. Okay, that's a trade. We can definitely trade this one. Oh, it will appear. And then the current IV percentile, we go to the trade tab, scroll down, it says 43 current IV percentile. That's a little high, okay? But just the same, yeah, it's a little bit higher here. Usually it has been much lower, but that was during the bull market. Now we're sort of a bearish market. 26 used to be, and now we're at 37. 26 being the lowest point, 25. Okay, that's a little too high too, so we're gonna put a pause and come back to it if we want, if we have to. Okay, so AXP is otherwise very good, but this IV percentile is quite high right now, but the other things do meet, and the stock is rallying strongly. I'm considering it because it's only one strike out of 4. Let's go to DG. Dollar General. Let's enter it here. Analyze trade. And here we are. September and July. Yeah, that's okay. I see that the volatility is below 40%. Unlock it and let's take a look at the chart. Dollar General, the stock is rallying very strongly after having declined very strongly on Walmart and Target's news. Obviously they must have reported good earnings, huh? Well, something here. Is that the earnings? Yes, they exceeded expectations, so they must have reported good earnings. The stock rally. So looks, it has the same issue. The volatility is still a little high. Okay, and what happens with that is if the market rallies, volatility may decline, and that works against us a little bit. Okay, let's work on this. Let's go to the stock and first the earnings. Let's do that again. 2.32 versus 2.41. That is 3.9%. It's not fantastic, okay? But obviously it surprised the street because they were expecting terrible earnings compared to Target and Walmart. Let's take a look at our implied volatilities. 31.71. 29.26, 27.55, and 28.24. Okay, that is a trade. Let's look at the liquidity for 45.45. Create duplicate. 46.50. Okay, 2.3, and the current IV percentile, go to the trade tab, 36%. That's it's hard to swallow. Those are two good potential trades, but they're not. Both AXP and DG And that's about it. Okay. How about AXP? I'd say we have 3 out of, this is, remind me if this blows up in my face, it's because of this issue. The volatility is still high. And the same with EG. The volatility is still high, hasn't declined enough. Okay? Tell you what I really believe. I believe that the market will continue to go down, but it's making time right now. And that means you're going to have a big decline sooner or later. Big decline. Right now it's just making time, going sideways, and we may have more candidates, but the decline may start in earnest within a couple of days. That's what I'm fearing, and then I will be out of all my trades. So that's my motivation to enter those 2 trades that are otherwise, except for the implied volatility being a little historically, compared to historical, they are still a little high. But if the market begins to decline from here, it will go back up. It won't come all the way down. But if it slows down on a move up, then you're going to have a loss. Okay, so having said that, I'm going to take the chance, okay? I would say, no, don't do that, that's crazy. I'm going to have half my position, and next week we'll see if we want to enter the other half. How's that? Okay, so we don't lose that much. That's a compromise. And AXP, the same thing. Yeah, we can certainly do one. Half the position, half my normal position. Normally I would not recommend these positions because the market is still, it may still decline, volatility. Let's look at the VIX. Yeah, 24, and it has been at 36, and we took plenty of profits as we did, and now we just have new trades. Let's look at the other position we were trying to get out. It was Nike, still not filling. All I can say is I'm going to make sure that it does before the market closes today, okay? But I will, if I have to lower, well, how about we lower it? Let's lower our bid, our ask, really. And I will keep an eye on it. That's all for today. Thank you very much for joining me, and see you next time. Bye-bye.